Welcome back to Investing Talk Podcast.
Today we're looking at Sigma Lithium.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Right out of the gate, I think the overall thesis on this company is extremely compelling. We're giving it an overall bullish rating of 9 out of 10.
9 out of 10, wow.
Yeah. And the core driver isn't just, a hopeful bet on the EV future. It's that the company has proven really flawless operational execution, and that success is what's driving massive institutional capital into the stock.
Even with the lithium market being so challenged recently.
Exactly, even with all that headwind.
Okay, so a 9 out of 10 in the materials sector right now is a bold call. If execution is the driver, let's unpack those operations. We just had the Q3 2025 results. What are the numbers telling us?
Well, the sheer pace of their scaling is what really stands out. The Q3 revenue numbers, they showed an astonishing 69% sequential increase.
69%, quarter over quarter.
Quarter over quarter. It's a speed of ramp up that, very few in the sector can match. And if you zoom out, that's still a powerful 36% year-over-year growth. So they're not just recovering, they're actively expanding.
That 69% jump is massive. I think for a lot of people just looking at the headline lithium price, they might be wondering, how is that even possible? Are they just hitting full capacity now, or is something else going on?
It's a combination of both, but it's mainly driven by that capacity ramp. You have to remember, they are a relatively new producer, and hitting these efficiency milestones, well, it unlocks economies of scale that older mines might have already maxed out.
So they're shifting from a development story to a real production story.
That's it, exactly.
And what about the physical production targets? Did they, cut corners or sacrifice quality to hit those big revenue numbers?
Quite the opposite. They confirmed continued on-target production.
Yeah.
Their Q2 2025 volume actually came in slightly above their own quarterly target of 67,500 tons.
Oh, really?
Yeah, they hit 68,368 tons. Just a slight beat. But that translated to a 38% year-over-year production increase.
Sticking the landing on targets while you're in a rapid expansion like that is genuinely impressive. So their full-year guidance for 2025, that's still on.
Absolutely. The full-year 2025 guidance remains firmly on track for 270,000 tons. And this is crucial because meeting that target, it confirms their status as a leading pure-play lithium producer. But volume isn't the whole story here.
Right.
What makes the investment case so strong is that they are highly profitable while doing all this.
Let's talk about margins then, because when you see companies push volume that hard, you usually see margins get compressed. How are they on cost control?
You'd think so, but this is where they really shine. Their disciplined cost management has let them achieve some of the highest margins in the entire space. Their cash operating margin was reported at 41% for the full year 2024.
41%. That's huge.
Yeah, it is. Now, you're right to point out that lithium prices have been volatile since then, but that 41% baseline, it shows an operational efficiency that lets them absorb price swings much better than peers whose margins are in the single digits.
So those underlying cost advantages from their Brazilian operations are real. They're not just a function of high commodity prices from a couple of years ago.
Precisely. It improves the quality of the asset and the management's ability to execute.
Okay, let's shift to the balance sheet. This kind of rapid growth, it always costs a lot of money. Did they have to load up on debt to finance this?
This is one of the most reassuring parts of the story. They aren't loading up on debt at all. They're actively deleveraging.
Deleveraging while expanding.
Yes. Debt was reduced to $167 million as of June 2025. That's down significantly from almost $220 million just a year earlier. It gives them enormous flexibility for future growth.
So we have operational excellence, a healthy balance sheet, all of which points to stability. How does the market reflect that stability?
Through its volatility, or really the lack of it. If you look at their beta, it's remarkably low, just 0.08.
0.08. For a material stock, that's almost unheard of, right? What does that mean for our listeners?
It means the stock price is largely detached from the broader market swings. Investors aren't trading it based on general economic fear or excitement. They're trading it strictly based on the company's own performance.
So it's behaving less like a volatile miner and more like a company with guaranteed output.
Exactly, which is the kind of profile institutional buyers just love.
That's a perfect bridge to their competitive advantage. I mean, what is their specific moat that makes institutions treat them like this?
Their advantage is built on two pillars. First, as we mentioned, the highly capital-efficient operations in Brazil. And second, and this is probably more important, they produce what they call triple zero lithium.
000. Okay, that sounds great in a marketing deck.
Yeah.
But for investors, what does that actually mean? Why would a buyer pay more for it?
It's a powerful differentiator. Triple zero refers to three sustainability pillars. Zero carbon emissions in production, zero tailings dams, they use dry stacking, and zero hazardous chemicals in the processing.
So it's a green product.
It's a very green product. And in a world where battery makers, especially in Europe and North America, face huge ESG mandates, sourcing this kind of lithium is paramount. It allows them to command a premium.
So the moat isn't just about being cheap to produce, it's about being green to produce, which opens up better sales channels.
Exactly. They are baking sustainability right into their margins.
That covers the fundamentals beautifully. Now let's pivot and see if the market's technical outlook supports this whole story. What's the chart telling us?
Well, the technical picture is basically just confirming the fundamentals. The stock has been in a consistently bullish trend, higher lows, higher highs, and critically, it is trading above both its 50-day and 200-day moving averages.
Which is that classic setup for strong, sustained confidence.
Right.
And what about momentum indicators? Is it getting overbought? Or is this accumulation healthy?
The momentum looks very healthy. Indicators like the RSI and the NASDAQ show strong bullish momentum, but they're not flashing any of those, severe overbought warnings. This suggests stable buying from long-term institutional players, not just short-term hype.
And what about the analysts? What's the consensus rating and what kind of upside are they projecting?
The consensus is a resounding strong buy. The average price target across analysts is $13.
$13. And the stock is currently trading around, what, $6?
Around $6.06, yes. So that represents some truly significant implied upside. We're talking about a projected increase of nearly 178%.
Wow, that kind of target just screams conviction. For analysts to project that kind of return, they must have total faith in that 270,000-ton guidance.
They do. And that faith is mirrored internally. We're seeing active insider buying trends, which is always a good sign. Management is putting their own money on the line. And this is being supported by increasing institutional inflows that see the same upside.
Okay, so strong fundamentals, great technicals, insider confidence. Let's look forward. For many people listening, the near-term catalysts are what drive the trade. What events should we be watching over the next 3 months?
The immediate future is loaded with potential drivers. We're looking at three major categories: index events, earnings reports, and, of course, the ever-present strategic speculation.
Okay, let's start with the institutional events. Index rebalancing can create some forced buying, right?
It can. The first big date is the expected inclusion in a key ETF rebalance, which we're watching for around November 28th. Inclusion means all the ETFs tracking that index have to buy the stock.
A predictable injection of demand?
Right. And then after that, around December 20th, we get the institutional 13F and 13G disclosures.
And why are those so important?
That's when we get to see the cards. The 13F filings show us exactly what the massive hedge funds and institutions were doing during the last quarter. If a big whale was accumulating, that becomes public knowledge, and it often drives follow-on buying.
Right, follow the smart money. Okay, what about the financial reporting schedule?
We have two pivotal reports coming up pretty close together. The Q4 2025 earnings report is due around January 15th, 2026. Then, shortly after, we get the full Q3 2025 full-year update on February 14th.
Why are they so close together?
The Q4 report is the quick snapshot, revenue production for the final 3 months. The full-year update is more comprehensive. It'll have the audited numbers, the full margin analysis, and most importantly, management's detailed guidance for 2026.
That's when we'll find out if those high 41% margins are sustainable.
Exactly. That's the real test.
All right, let's get into the speculative buzz, the rumors that can really move a stock. What are the big ones circulating right now?
There are three potent rumors fueling the market, and we have to stress, these are speculative.
Of course, but still very relevant. Lay them out for us.
First, we have the persistent speculation around a strategic acquisition. The market is buzzing about possible takeover approaches from a global battery company or even a major mining conglomerate.
They'd be buying direct access to production, and a very clean production at that.
It's a prime candidate. And a successful bid would trigger an instant and massive re-rating of the stock.
That's the dream scenario for long-term holders. Okay, what's the second rumor?
The second is the expansion of offtake agreements. There are persistent rumors that they're close to signing new, long-term supply contracts with other major EV makers. More big-game agreements would just solidify their future revenue.
And that would certainly help justify that $13 price target. What's the third one?
That one centers on downstream integration. The chatter suggests the company is exploring moving further up the value chain.
So getting into refining or battery precursor production themselves.
Exactly. That would move them from being just a material supplier to a much higher value-add business, which would obviously have a huge impact on their potential margins.
So that's a powerful list of catalysts, but we have to look at the other side. Despite the 9 out of 10 rating, what are the primary risks here?
The primary risks are really external. I mean, continued volatility in the lithium price is the big one. Even with their high margins, that would still impact revenue. And then there's just general macro market risk. But company-specific risks are considered pretty limited and manageable at this point.
So the investment case seems strong across different time horizons then. The fundamentals provide a shield, while the catalysts offer that short-term upside.
Absolutely. It's a compelling play for someone looking for short-term alpha from the catalysts, but also for a long-term investor who wants to capture that structural growth as the EV supply chain matures. The confidence here is really rooted in execution, not hype.
That paints a very clear picture. Before we wrap this up, what's the one provocative thought you have for listeners to think about regarding this company's future?
It all comes back to that 000 focus. Given their commitment to environmentally sustainable, low-carbon lithium, the ultimate driver of their future price might not just be volume, how many tons they ship. It might be whether the market eventually assigns a truly significant premium valuation specifically to ethical ESG-compliant production. If policy keeps pushing for cleaner supply chains, that premium could define their entire valuation for the next decade.